we are a global clearinghouse for financial institutions. So we help large global banks down to smaller payment companies move and manage money around the world. And we've raised about $40 million to do that. And really the center of our story is that incentives are misaligned in banking, in treasury and trade services. In the 80s, Citi built this huge network that was not meant to scale to the number of financial institutions that you see today. It was made for hundreds to thousands, not hundreds of thousands of banks around the world. And they've built that with the same cost to serve, whether you hold $100 million or whether you hold $100 billion. Everything is manual, everything is slow. And that deficiency leads to everyone to tell you that the system is broken and it needs rebuilding. And we believe that actually that's fundamentally not true. It's not the system, it's the participants. It's banks building lending books around the world using funds for liquidity and overnight rates. So you see that these large, globally systemic, important banks have such a high cost to serve you that mid-market banks cannot work with them. And as such, everyone will then turn to smaller regional banks who are appropriating their charter to serve this clearing use case, this payments use case, but they fundamentally are lending underneath the hood. These fintech forward banks have over $113 billion in active loans currently, with an average loan deposit ratio of over 75%. That means that they're keeping 25% of the money that you're moving. When they do hold onto your deposit in reserves, they spend their time keeping that total number under a community banking limit. So they keep that number under $10 billion, so they're shifting your funds onto other community banks with the same liquidity issue. Not one of these banks can actually provide you with wholesale treasury services because they need you to move that money or leave it there long enough that it can be lent out into their mortgage portfolios, etc. And so they're not really incentivized to help you earn interest on that money, to help you hedge currency risk with FX derivatives, to create more forms of kind of fiduciary custody. And in a world where money is inherently cross-border and deposits are actually really, really short-term, we should be super worried about the lending that these banks do, as they're really appending a payment business to increase their lending business. And so the banks with liquidity and treasury are slow and gated, and the fintech ones are leveraging your funds for lending, so where do you go? Clearing, custody, and liquidity are a fiduciary service, and we believe should be run by 100% reserve-backed banks. And we've built a really fast-growing business doing this. So in 2025, we 55x'd our business. We grew 50% every single month, and we launched 6 licensed markets in 10 months, following this model with this demand. And the combination of our products is a really powerful differentiator with that. The mix of being able to move money, hold on to it, and help you manage your liquidity is really powerful. And this space is really, really large and really, really stagnant. Everyone tends to build on this top layer, this payment layer. But people are missing the treasury and trade opportunity that we're building in. And these banks have very large pools of profit and funds. And so everyone builds at this top layer, creating margin-compressing payment businesses. Even when you're using a stablecoin today, you are still leveraging the same underlying treasury and trade service to settle your funds in the fiat world at the same time. And so we're changing that bottom layer of the financial stack. We're really realigning incentives in there, building an institution that is 100% reserve-backed at all times.